Good afternoon, and thank you all for joining us here on the webinar. My name is Paul Myers. I'm the CEO and Chairman of Advocate Capital, Inc., and I'm happy to join you here from our studios in Nashville, Tennessee. Advocate Capital is a law firm financing company that provides the Abstract case expense funding service to roughly 550 law firms across the country. And we're pleased to have you here. I know we've got a number of clients on with us today, and I welcome you. Today, our special guest is Robert Wood. He's here to discuss law firm taxes and tax strategy with us. Rob is often listed as among the top 10 tax lawyers in America. He handles a broad range of tax planning and tax controversies. He also serves as an expert witness on tax matters in civil cases, class actions, and disputes over independent contractor status. He's a widely published author known for explaining and demystifying complex tax concepts, which I know I need. He's also well known for his expertise in advising plaintiffs, defendants, lawyers, and settlement funds on settlements and judgments. He authored the leading book on this topic, Taxation and Damage Awards and Settlement Payments, as well as the Bloomberg Tax Management Portfolio, Tax Aspects of Settlements and Judgments. Rob, thank you for joining us. Welcome.
Thank you, Paul. Nice to be here.
We're going to start with just some basics of financial statements. This is primarily about tax, and financial statements in GAAP are not necessarily, they don't necessarily jibe with tax treatment a lot, but in certain areas they do. Rob's going to cover different types of corporate entities and structures for law firms and how that might affect your tax situation. He's going to cover different types of taxes that may be applicable. We're going to get into specifically how case expenses should be treated for tax purposes. Talk a little bit about an IRS letter ruling and a court case that are very applicable, and then also talk about the difference between self-employment taxes, withholding issues, things like that. And then at the end, we'll get into Rob will cover some topics related to potential ways to defer taxes and defer fees on settlements and verdicts. And then we'll take some question and answers at the end. If you have questions as we go through, there should be a question box on your webinar page. Feel free to type them in, and we'll get to as many as we can when we wrap up. So I do want to offer this disclaimer. Although Rob is a lawyer and very well known, has a lot of expertise, this is the webinar is really just for informational purposes. We want to make sure you have some information, and if you'd like, you can share this with your tax or legal or accounting professional, but make sure to get their advice before you take any action. So just wanted to get that out there. So we'll get started with a quick overview of financial statements. I'll cover this part. And like I said, financial statement treatment and GAAP standards are not always the same as tax, but there are some similarities. The income statement is very basic. It's what you brought in versus what you paid out, and then what you have left. Put it in accounting terms, it's your income less your expenses equals your profit, or technically or potentially your loss if your expenses exceed your income. Pretty simple concept. The balance sheet is a snapshot of a point in time, and it shows what you own less what you owe on that. It equals your net worth. And again, in accounting terms, it's the assets of a business less the liabilities equals the equity. So where these two, where tax and accounting should come together and have the same principle is when it's related to case expenses. And Rob will get into the tax treatment, but case expenses are basically an asset. They, from a GAAP perspective, they should not be expensed on the profit and loss statement. They should show up as an asset, because technically they're a short-term loan, if you will, because you anticipate receipt of repayment of those funds. So from a GAAP perspective, those should show up as an asset on the balance sheet, not as an expense on the profit and loss. So with that, I'll let Rob kind of take over here. We'll let him talk a little bit about the law firm entities and some other concepts, and then we'll get back to the case expenses. So Rob, how does the different type of entity that a law firm can take affect their tax situation?
Thanks, Paul. Well, so, and this is hardly a comprehensive view about law firm entities and structures. There are a bunch of variations. But first and foremost, with any business, law firm or anything else, it's, I guess, as a tax lawyer, I think, what kind of tax return is it going to file? And of course, what kind of taxes is it going to pay? So the simplest of all would on the slide there is proprietorship. So if you don't really know what it is that you have, you hang out your shingle, you are a proprietorship. And that would mean that and that would be true if you're, doing a garage business on the side, selling on eBay or something. Anything that you do is a proprietorship if it doesn't have an entity around it. And that would be Schedule C. So if you look at a tax return, if you look at your past tax returns, those of you who are solos may be filing Schedule C. All of these links, I think, are not going to work on the slides, but
Right.
if you sort of cut and paste that title or remember a few words from the title and go to my website, it's woodllp.com. There's a publications page, and we're actually desperately trying to transition to a more modern website, but there are 4,000 or 5,000 articles on there that you can get for free. So if you type in tax fraud or legal fee deduction or sexual harassment, or in this case, proprietors or Schedule C, you can pull up some of these articles. I guess one bad thing about Schedule C, in my view anyway, there's nothing wrong with them, but one bad thing is that they are statistically more likely to be audited than lots of other tax returns. Partnership tax returns, for example, which would be a multi-member LLC or a partnership, are notoriously under-examined. I mean, the IRS says this all the time. I think everyone knows it, but proprietorships are the reverse. They tend to get audited. And one reason has nothing to do with you as lawyers, but one reason is simply that a proprietorship Schedule C is where sort of hobby loss activities have traditionally been. So if you are, you're a lawyer and even in a firm maybe, but you're also, raising horses on the side and generally lose money, but you write it off saying, I'm going to make money someday. Obviously, the IRS likes to target that, and it's almost always Schedule C. What other choices? So LLCs, professional corporations, single member versus multiple member. I mean, that some people sort of gerrymander things to get multiple members. That's not difficult to do. The idea is to have a partnership tax return rather than a proprietorship. S corps versus C corps. Not too much talk about this right now, but starting in 2018, after the big sort of Trump tax bill that passed around Christmas of 17, the corporate tax rate went way down, as you probably remember, 35% to 21%. So it's not great for law firms, but 21% is a low corporate rate, and then you get the money, presumably bonus it out to yourself as an individual. But S corps are more efficient, single level of tax, which is the same as the LLCs or partnerships. Okay. And let's move on, Paul.
All right, Rob. So here you talk about all the different types of taxes and payroll taxes that firms or individuals may be subject to. Would you like to expound on this?
Sure. So, I mean, nobody likes taxes. I guess as a lawyer, you've got a bunch of them, and really any business does. So first and foremost, federal income taxes, state income taxes. If you're operating in your offices in Texas and you're a Texas lawyer, you may not think about state income taxes because Texas doesn't have one. But what if you have an office in multiple states? What if you are a Texas lawyer, but you occasionally come to California to do a trial? So it's worth, and by the way, California is probably the biggest offender on this. Sometimes says, hey, you were in California for a month for a trial. We think you owe some California tax. Yeah. So it's worth thinking about it anyway. If you have multiple offices, big law firms that file in, that have, 10 offices, file in lots and lots of states, and oftentimes these days maintain control of all partner tax returns.
Right.
So I guess just be aware that if you are dipping in and out of states, that those issues can come up. In some ways, more frightening, I think, than income taxes, if they go bad anyway, would be payroll taxes.
Mm-hmm.
Some people do it themselves. You got employees. If you may or may not, as a lawyer, be employed by your own law firm as an
Right.
employee. But if you're a partner or proprietor, of course, you wouldn't be having taxes taken out. But all your employees, you'd have payroll taxes, and that's federal, state, District of Columbia has them as well. So do it yourself. I just would say be careful. Payroll services are good. That's what most people do probably. Just be careful that you're relying on somebody who's reliable. And what if there's a problem? So 6672 is actually an Internal Revenue Code section. It's one that lots of people know because of it may have happened to them.
Right.
Responsible person. So if a business, including a law firm, is taking out pay from employees and then doesn't send it in to the government, uses it to keep the lights on, and this happens a lot, the government will eventually catch up with you, and anybody who's a responsible person, and that's typically check signers, owners, sometimes directors, anybody who moves is likely to get one of these, and they're saying, we want you to pay 100% of the money. And they typically do this, and they may send 3 of those, 5 of those, 10 of those, as many people as move, to try to collect the money from somebody. So just be careful.
Right.
Next slide.
Right. And Rob, another thing, we've not had this issue, but we've needed to address this. We have employees in other states, not just the withholding that you need to worry about. There's also workers' comp issues. It's not necessarily tax related, but it is HR related, so you need to be aware of that as well.
No, you're right.
Okay, then we get to the IRS private letter ruling, 8246013. This is really kind of where we get back into the case expenses as an expense or as a loan and how the IRS looks at this. Rob, would you go into this a little more deep?
Sure. Well, first of all, I think this, as Paul rightly points out, is in some ways the shot. It's not the slap heard around the world, but it's sort of the shot heard around the world. IRS comes out with these things, IRS private letter rulings, and you might think, well, why does anybody care? I mean, they're not binding. They say that they're not binding on anybody but the actual taxpayer who got it. But tax people all read them, and it's sort of an indication of what the IRS policy is. There have been a handful of tax cases on this very point since that ruling, where people have tried to push back on certain things, which we'll mention. But essentially, the notion, which this private letter ruling says, is that if you're a contingent fee lawyer and you're paying for trials, you're paying for travel, expert fees, FedEx bills, court reporters, all of the stuff that keeps your cases going, your first instinct, it would be, well, heck, I'm paying FedEx, I'm paying because I got to go to Cincinnati tomorrow. All those things are business expenses. You're paying them, sure, and this is your business. Surely they're business expenses. But the case that private letter ruling says, no, they're not. They're not your expenses, because look at your fee agreement, contingent fee agreement, which typically will say that you are going to add up all the expenses and you get those back from the client at the end of the case. Right. So the short answer is you can't deduct them. It's essentially treated as a loan to the client.
Well, it's kind of a double whammy, because you're right. Intuitively, it does make sense. Hey, I wrote a check for this, or I use my credit card and it's an expense and I should be able to deduct it. But not only are you out of pocket the money, you can't deduct it in that tax year. Yeah,
I mean, it's a double whammy, or it's a good description. And you're right, it's counterintuitive. Lawyers argue about this. It's always surprised me how many people are doing it wrong, or sort of don't know. And of course, I guess whether you're deducting them or not, it puts a premium on, on accounting for things, trying to run through, tally up, was this for the XYZ case or the ABC case, or some of both. But yeah, it's a big cost, and as all the lawyers listening, I'm sure know better than I do. I keep having people tell me that these expenses are going up and up and up. It's more and more expensive to run cases.
They are. And, from our standpoint, I know, again, that, accounting principles and GAAP and financial statement treatment are not always the same as tax treatment. But in this case, I think it's a valuable business tool for a law firm to be able to see on their balance sheet how much money they have tied up in case expenses. So if they do it the proper way from a GAAP standpoint, it's going to help them do it the proper way from a tax standpoint. Plus, it's just smart business to know how much you have tied up. I mean, we have conversations with thousands of lawyers every year, and sometimes I get the response that, when I ask them, how much money do you have tied up in your case expenses and active cases right now? And they say, I don't know. We spend probably about $20,000 a month, but, at the same time, they have money coming back in, so they really don't have any idea of the amount of capital they have tied up in that. And I think that's just a really good business practice to have your finger on that pulse.
Yeah, no, I couldn't agree more. And I mean, I often don't see those things, but yeah, that would, and I would imagine, just as you're saying, Paul, that as a sort of a business tool, it might even inform the lawyer, well, in the new cases I take in, should I take in, cases like that one over there that was super expensive, or should I take in cases like this other one that was, where the costs were very low?
Yeah. It's good, very good point. What kind of risks are law firms running when they, from a tax standpoint, they try to write off and expense the case expenses?
Yeah, well, and by the way, I mean, I should have said at the outset, I think this might be in that private letter ruling, but it's kind of implicit in the concept of it's a loan. So what happens if the case craters?
Right.
You don't get a recovery. Well, obviously, and this is not a good result, but then of course, you're never going to get the money back from the client. So then, of course, it really is your business expense.
Right.
But if the risk that Paul asks about is, I'd say it's mostly indefensible, meaning if the IRS catches you, the IRS audits, you're going to lose because the law, unfortunately, is pretty clear. And by the way, I should say, as some of you probably know, I mean, there have been various efforts over the years. I think one of the trial lawyer groups, I believe once or twice tried a legislation to get through to fix this so that lawyers could deduct these expenses when they pay them. That hasn't gone anywhere, but yeah, I think the risk is, you're going to lose.
Right. And I guess the impact is they're going to go back and disallow those deductions and make you pay them plus penalties and interest.
Yeah, I mean, that's right. And usually, I mean, if you are competently represented anyway in an IRS audit, and I think kind of no matter how big or small you are, trying to handle interactions with the IRS yourself is a mistake.
Right.
There's too many dangers. I mean, even if you had the time to do it. But as to penalties, I mean, again, substantively, I think you're going to lose the deductions.
Right.
And the IRS doesn't have the ability to waive interest. They do, of course, have the ability to waive or to compromise penalties. So that's the place where, and then the question is, how far back are they going to go?
Right, and that was one of the questions I had, is how far back can they go to disallow those deductions?
Yeah, so it sort of depends. I mean, the general answer is that all of you probably know is 3 years. The main IRS statute of limitations on tax returns would be 3 years. So 3 years after you file. So you file, and then 3 years goes by after that, and then that tax return is mostly safe. I say mostly because there is a 6-year statute of limitations that also applies in some cases. Most of these kinds of things I wouldn't think would trigger that. It's there so 3 or 4 tests. The biggest one, I guess, would be if you've omitted 25% or more of your gross income, but
Mhm.
but that has changed. There's actually been litigation in the past 10 or 15 years, including the Supreme Court on this. And if you do something that has the impact of a 25% understatement of income, that can trigger it as well.
Okay.
And then finally, if the IRS says you were fraudulent, meaning, hey, you knew about this all along, they can go back an unlimited number of years. And that
Wow.
doesn't have to be criminal. It can be civil fraud. They can go back an unlimited number of years. So it's not common. I mean,
Right.
and the IRS has a bit of a burden to show fraud, but they do
Yeah.
sometimes, they do sometimes throw out the, hey, we think this was fraudulent, which not only gives them more years, but also the civil fraud penalty is 75%. So if you
Ooh,
owe $100 in
goodness.
taxes, $75 penalty. So yeah, it could be a big deal.
Yeah, it's pretty harsh. Have you found yourself, have you been able to help clients of yours switch from the wrong way of doing it to the right way of doing it?
Yeah, and I mean, some cases it's a question of, well, are we going to amend any returns or not, or are we going to just gut it out for the past? And by the way, speaking of amended returns, so the tax law essentially says that if you knew that you were doing it wrong when you filed your return, which of course a tax return is, you're supposed to sign under penalties of perjury. If you
Right.
knew you were doing it wrong when you signed your return, you really should amend. Some people would say must amend. On
Right.
the other hand, if you were ignorant of it, you didn't know about the mistakes, you discover them later, the IRS says that you should amend, but there's no actual legal obligation to do it. So many people will just sort of transition to do it correctly in the future. But I think it's worth discussing, exposure and how much money there is and that kind of stuff. And also how you effectively bridge from the old way to the new way. Some people do changes of accounting method. It's worth
Right.
talking about.
Okay. And that's where really good tax and accounting and legal advice can come into play. That I think each situation can be a little bit different. And that's why, again, the disclaimer that this is good general information for you folks to have, but if you have real questions about your specific situation, get with a competent professional. And one thing I wanted to point out, this is from a lending perspective. We probably take 15 to 30 applications every month here at Advocate. And when people do get crossways with the IRS, especially at the firm level, and there are tax liens involved, that will impact your relationship with any lenders existing or future, mainly because that IRS lien trumps anything that we would have. And so it generally scares off lenders. So that's kind of a non-quantifiable impact of this kind of thing. So if you do get audited and caught and whatever the amount is that is owed is not able to be paid, pretty quickly, they have the right to lien your assets. And like I said, that there's an impact to your lending relationships from that standpoint.
Yeah, and I would just say, Paul, I mean, we're really not talking about tax sort of controversies here, but
Right.
For any of you who have ever had any kind of sort of run in with the IRS, I mean, procedure and sort of the order of events and all that are really important. Probably more important, or I don't know, maybe as important as all the litigation that people do. So it's really Paul's right. I mean, tax liens will impact all sorts of things, and they're public, so it can be
Right.
embarrassing. I've seen a lot of clients in that circumstance. So no matter how bad it is, if you sort of keep the process going, the dispute going, the audit going, and you respond timely to notices, protests, this sort of stuff, unless you are filing in court or unless you get, as Paul says, a sort of a determination and then a lien, it's all private. And so people don't know, and then you can work it out quietly as opposed to in the public sphere.
Right. Good information. See, our next slide is about deducting client costs. We've talked about this, but Robert, if you'd like to, again, the link at the bottom of this particular slide, we will make sure we get to all the participants in our follow-up communications. But Rob, if you'd like to expound on this.
Sure. And by the way, you could tell, I think that one about Schedule C was from 2011 and this one's from 2010. I mean, I write a lot, but I guess you can say this area hasn't changed a whole heck of a lot just from the age of those articles. So I mean, client costs, you know, if you're paying hourly and you know, and you're adding the FedEx bill to charging hourly and adding the FedEx bill to the client pays it. It all sort of washes out very quickly.
Right.
But contingent fees, gross fee agreement, traditional and hybrid. So I guess it's worth looking, and I've seen a lot of legal fee agreements. There are some that are super common. There are lots of variations. So I think it's worth looking at yours, your specific one, and you may have several, to make sure that you understand how the costs are going to work. By gross fee agreements, kind of in the middle of the slide there, that raises what is famous, I guess, in the tax world, the Boccardo case.
Right.
I think he might be dead now, but it's a famous lawyer in San Jose, and he fought the IRS a lot. I think it went to the Ninth Circuit twice, as I recall. Anyway, basically the idea is, you know, fighting on this, the point that we first made about that private letter ruling. I should be able to deduct my fees. And so what the Boccardo case says, which is, to my knowledge, still good law in the Ninth Circuit, is that you, if it's a gross fee agreement, meaning that you are really paying the FedEx bill, and you, kind of going back to Paul's point, if you are tracking all your expenses, you can figure out how much cases are costing you, which cases should you take on next. If you're doing all that, and you're paying it, just up your contingent fee. So instead of 40% plus costs, make it 45%. And if you are, you know, right that it's going to be roughly 5% costs, then if you're paying the fee, if you're paying the cost yourself, and it's just built into your fee, then you can, at least in the Ninth Circuit, deduct your costs because they really are yours. I think this may work everywhere. I think the only reliable law on it is the Ninth Circuit, but I've seen people adapt it. But I guess the fear would be, it's not really a tax fear, it's a business fear. Well, what if you think it's going to be 5% cost, but it's 15%? You know, what do you do then? And then I guess you have to eat it.
Rob, tell me, and this is as much for my edification as it might be for others on the webinar. What is the geography of the Ninth Circuit?
Oh, sorry. Gosh, I should be able to. It's a big circuit. It's California, Oregon, Washington, state of Alaska. I think Idaho might be in it. I think Montana. It's a huge circuit, and they have for years, you know, talked about splitting it. That's controversial, but yeah, it's a bit. And I would say among tax lawyers, in the old days anyway, I haven't heard this recently, but the Ninth Circuit, I've heard it described as the taxpayers' circuit frequently, because I think I don't know if Ninth Circuit judges, you know, hate taxes more than the rest of the judges or what, but it's a place where some favorable decisions like Boccardo have been decided.
Right. Yeah. So it's really important, particularly if you're going to try to use Boccardo as I guess not a shield, but as a reason to deduct case expenses, that you have the proper type of attorney-client agreement, and have your ethics professional and tax professional take a look at that. Let's see here, Rob. Next up, you taught, this is a little bit more about self-employment tax and whether or not you should withhold. Can you tell us a little bit more about this one? Sure,
and I think this ties back into the choice of entity sort of issue, and largely, I mean, you can plan. Most of you are probably not setting up a law firm today or tomorrow. So most of you are probably, you know, sort of in a system already, either one that you picked or one that just kind of happened. But self-employment tax is what you pay if you are a solo proprietor. It's also what you pay if you are operating in a partnership. In partnership, which could be in a LLC in some states, or LLP, a partnership, and that would file a partnership tax return. So self-employment tax is essentially both halves of the employment tax. It's 15.4, I think it is, percent for the first roughly $150,000, and then 2.9%, I think, beyond that. So it's and you'd pay the same thing if you had your law firm hires you as an employee, like a professional corporation.
Right.
Stuff that really started, and I'm old enough to remember this era in the early 80s. Every doctor and lawyer, most doctors and lawyers and other people started forming a professional corporation that would hire them. And then the self-employment tax versus employment tax is roughly the same, but there's a timing difference. If you have withholding taken out, you get a paycheck, and the taxes are taken out, and then you sort of true up when you file your tax return. Right. If you're paying self-employment tax, you send the money in yourself.
Okay. See, I think now we're going to transition a little bit away from income payroll type taxes and strategy, and into, Rob, strategies that firms and individual lawyers may be able to use to defer taxes and issues like constructive receipts. So could you go into this a little bit for us?
Sure, and I'd say it's an area, even among tax people, honestly, I think this is an area that's often confused. So lawyers, I think, can be and should be forgiven for stumbling over this one a lot. I mean, sometimes you kind of scratch your head, and there's not only a lot of law on the subject, but also some practical considerations. So the basic idea of constructive receipt, classic example is probably the person who's going to get a bonus at the end of the year, and the employer says, here's your bonus check, and the employee says, oh gosh, no, thank you, but can you give it to me in January? And so if the IRS is sitting there in the room hearing this, the IRS answer is that doesn't work. It doesn't matter if you pay it in January, it's still December income because you could have gotten it. And as a practical matter, if the employer in my example said, yeah, sure, no problem, we haven't cut the check yet, we'll give it to you in January, and issue your W-2 or 1099 or whatever it is in next year, a lot of that sort of thing happens, I think, as a practical matter. But the question is, could you have gotten it? So how does this apply to lawyers? Right. Contingent fee lawyers, if you are working on a case for 5 years, as plaintiffs lawyers that are listening, I'm sure know, painfully, you're working on the case for 5 years. It's, you've earned all of the money literally, but it isn't quite done yet. And the last, 0.5%, you got to get the thing signed. But getting the thing signed, which you may not sign, your client signs the settlement agreement, that triggers your right to the payment. That means that's kind of when the income, it's sort of too late. The settlement agreement signed, it says, we're paying all the money to your trust account, and then you're going to disperse to the client. Right. That's kind of the pivotal event. So if you sign that, and then you say, or the client says, well, no, wait a minute, I want to pay the money next year, or I want to pay the money in a structure, or you say, I want to structure my fees. Right. Classically, the answer is it's too late then.
So you really need to be planning well ahead for this. If you think something's going to settle prior to executing any settlement agreements or receiving any funds, you need to have these structures, whatever it might be, in place.
Yeah, I mean, the thing, and as you might guess, sometimes there are workarounds, kind of Hail Mary passes, but I'd say, as a practical matter, what do you do with this? This probably happened to many of you. I know I've seen it. So, you're thinking it's been a really good year for you, let's say, and you're thinking that that case really isn't going to come in. Yeah, documents got signed or something, but the money's not going to hit until January. But instead, you get the wire on December 29th. And, your office is closed, everybody's gone, and you got this pile of money in your trust account. There may be ways, and I would say, as a lawyer for a lot of plaintiffs, classically, that's not only your tax problem, it's your clients as well, because
Right.
you are the agent for the client, and your fee agreement says you're going to disperse it. And I've actually seen a few of those audits over year-end payments. Again, sometimes there are ways to get out of it, but just be careful. And as Paul said, if you want a structure, or if the client wants the money in January, or if you want the money in January, for heaven's sakes, plan ahead, either with a qualified settlement fund, which I think you talked about, Paul, before, or I can discuss too, or a structure, or just tell them you're not signing until January. I should say this: if you have a settlement agreement that says we're all signing, we're all agreeing, and the money is going to be paid in 2 installments, X% now in December and Y% between January 2 and January 10. That's what you have to do. That works. It works.
Right.
I mean, it's 100% reliable in terms of making sure that you're not taxed on all of it in December, but it's got to be in the document before you sign.
Okay, that makes sense. And kind of segueing now into those structures that you were talking about, some of the benefits and pitfalls of structured fees.
Sure, and in this area, this article, this 2021 one at the bottom of the slide, where are we now, is a good, I think, a good sort of summary of just sort of generically what structured legal fees are about. I must say, I've been doing this a long time, and it still kind of amazes me that plaintiffs' lawyers are able to do this. I mean, and I write a lot of opinions on structured legal fees and work with a lot of lawyers who are doing them. But it's a really good deal. I mean, if you want to do that, meaning you're 40%, settlement agreement signed, but you think, I don't really need the cash. I'd rather have the cash, hopefully earning on a tax deferred basis, kind of a large IRA or something, and to pay me over time. So there are reliable mechanisms to do that. The most traditional, I guess, most foolproof, if you want that word, would be life insurance annuities. That's the Child's case from 1995, I think it was, tax court in 11th Circuit, which basically says if you do it and it's in your settlement documents so that you can't get the money, it's going to Allstate Life Insurance Company or whoever it is, that works, and you won't be taxed until you actually receive installments over time. As you might expect, creative people have expanded on that and made vastly more flexible structured legal fees, which involving portfolios of stock securities and so on. And so if you're not familiar with structured legal fees and you want to explore them, people are welcome to contact me. But there are lots of resources around, and get educated. I think kick the tires before you buy.
Good point, Rob. And another, again, this is not my area of expertise, but QSFs have become kind of very popular lately. Could you give us a quick overview of what a QSF is?
Sure. So a QSF's Qualified Settlement Fund went, and I see a lot of them and have written a lot about them. Qualified Settlement Funds went into the law in 1986, so it's been a while. They were at that time designated settlement funds, and then in 1993 is when the IRS actually came up with the better version of the designated settlement fund, which is the Qualified Settlement Fund. So Almost no one uses the old DSFs, designated settlement funds, anymore. It is essentially a tax neutral intermediary, if you will. Defendant pays the money into a qualified settlement fund, and then that is not treated as received by the lawyer or the client until it comes out. Okay. Pretty easy to, very easy to set up. There are commercial providers that set them up now in a day. They're also, customized versions. I've done a lot of them myself. Traditionally, class actions, big cases, I've seen and advised qualified settlement funds that have gone on for a decade. Wow. But most of the time, I'd say these days, they exist for a relatively limited time. It's to get the defendant or maybe multiple defendants out of the picture, and then allow you to, a plaintiff and lawyer, to figure out when you want your money and how you want it.
Right.
And so I'd say that is worth a lot, I think, because it does give you and the plaintiff time to figure out if you want a structured settlement, if you want cash, if you want some of each.
Right.
So they're quite flexible, and most people, I should say myself anyway, think that if there is no controversy, you're not still trying to track down plaintiffs, or you're not fighting over who's going to get, which share, which lawyers are going to get which share, which liens are going to get paid. If all of those things are resolved, all of those things being great topics for having a QSF, but if all those things are resolved and it's just your money sitting there,
right,
you shouldn't leave it there for very long. And by very long, I'd say a maximum of a year.
Okay.
And probably less, but I wouldn't go over a year if it's really just a holding pattern, in my opinion, anyway.
Right. You had a note there about borrowing from QSFs. Tell me what you want to cover on that, because it's kind of an interesting topic for us.
Yeah, and I'd say mostly it's a complex and nuanced one. I think there is a risk, and I should have mentioned borrowing in the context of structured legal fees as well.
Right.
There it is, I think, more legitimate than with a qualified settlement fund, just because I think the qualified settlement fund, there's probably a bigger risk that the borrowing is just going to be treated as a distribution.
Okay.
Any kind of loan, you all know the classic sort of a rule that a loan, if someone loans you money, it's not income to you. So somebody hands you $1 million and you sign a note saying, I'm going to pay you back, it's not income. But of course, what happens if, it's kind of an illusory promise, it wasn't real, it's your uncle, and he says, forget it, don't worry about it. Of course, that means it's income to you. So at that point, so in a commercial context, some people borrow out of QSFs. It's not 100% wrong, but I think it's worth looking at your circumstances. Same thing with structured legal fees. If you're borrowing money, will it be integrated with your fee structure? There are some hurdles to jump over, because what you want is to be able to access the capital without paying tax on it.
Right. Okay. Well, thank you. That's all good. I mean, I know that structured fees and QSFs have become very popular, and I know that we've been asked before to lend against certain of those types of structures, and we've relied on Rob for guidance and advice on that front. So if y'all ever have any questions like that, feel free to reach out to Rob. If you have your own tax or accounting specialist, do get their advice as well. Again, the disclaimer, this is all for informational purposes. We hope it's been helpful for you. I appreciate Rob being with us. We're going to have hopefully some questions coming up, but I did want to remind you that if you have questions about your specific situation, please get with a legal, tax, or accounting professional and get their guidance. So if you have any questions or comments, please put them into the question box. One question we have, do you count reimbursement of case expenses as income on your tax return? So if you put out these case expenses and then 2 years later you get $50,000 after you settle the case back on the case expenses, is that considered income?
It depends. If you're doing it right, the answer is that it shouldn't be, because you haven't deducted them.
Right.
If you are, if you're doing it wrong, and you've deducted $50,000 for a trial that you had to conduct, and then 2 years later you get the $50,000 back, then the tax concept is called the tax benefit rule.
Okay.
Is essentially that you deducted it before, and therefore when you get it back, you got to treat it as income.
Okay, that makes sense. And someone asked about doing an example of the proper treatment with concrete numbers.
We're talking about case expenses again.
Right, just as far as how you treat them for taxes. If you're take it like one specific case, I think.
Okay, well, I'm not sure I can be too specific, but I guess using that $50,000 example, suppose
right.
that you get $1 million recovery, 40% of it is yours, and the legal fees are $50,000.
Right.
So the $50,000 you've been, let's say, paying not in one go, but paying over time as you process the case.
Right.
You are not deducting, ideally, not deducting
right.
those $50,000 of expenses. You're tracking them
right.
so that you know how much it is. And then at the end of the case, and this is a question about what the fee agreement says,
right.
what does it say what's supposed to happen? Is that $50,000 taken solely out of the client's side, meaning out of the client's 60%? That's kind of it means 60-40 is the split, and the client pays the 50,000. I think that's probably the most common fee
right.
agreement. And so the $50,000 simply comes out then. I think.
Right.
Hopefully that made sense.
No, I think, and that's the tax treatment from a financial statement standpoint. The way it would work is, as you spend that $50,000 over in case expenses over the course of the case, the asset on your balance sheet would go up, because it'd be like a loan that you're making to that client.
Yeah.
And then at the end of the case, when the $1 million in settlement, maybe you get $400,000 in fees, that would be income. And then you get the $50,000 in expenses reimbursed. That would just be a negative. You would deduct it from that asset on the balance sheet, so it would kind of zero out. You still get the money, but only $1 million or only $400,000 of its income.
Yeah, that makes sense.
Okay. Let's see here. Another question. Would you, Rob, recommend that a law firm structure, if they're just starting out, as an S Corp or a single member LLC?
I guess it sort of depends. I'd say probably the biggest disadvantage of the single member LLC. This is either a solo lawyer, I presume, or at least a solo owner lawyer. Meaning,
right. Yeah.
There might be other lawyers who are employees. To me, the disadvantage of the single member LLC is that for federal income tax purposes, that is a disregarded entity unless you elect otherwise. So, and you can, by the way, it's kind of uncommon, but you can, as a single member LLC, you can elect S Corp status, to elect to file an S Corp return, even though you haven't actually formed a corporation. But I guess my answer would be, most of the time I'd rather have the S Corp than the single member LLC, because the single member LLC will be treated as a proprietorship, meaning Schedule C, which is that thing that I told you I typically think is better avoided.
Right.
You're filing a Schedule C. So I think it's a better looking, to me, it's better looking to have your personal tax return and your S Corp return. And the S Corp is obviously the business. And I think that's cleaner and actually also less likely to be audited.
Okay. Good points. I really appreciate everybody tuning in. I definitely appreciate Rob joining. On the screen, you can see Rob's contact information. As I mentioned, his bio is pretty impressive. He knows a lot about these tax issues. If you have any questions, as he said, probably shoot him an email. He is a well-known author and expert in these areas, and I really appreciate your time today, Rob. It's been great. Question, it says, is the date of the tax triggered when the attorney acts as a client agent or when the insurance check is deposited into the, I guess, this may be a constructive receipt question, Rob.
Sounds like it, yeah.
Yeah, is the date of, I guess, is the date of constructive receipt, is it triggered when the attorney acts as the client's agent or when the insurance check is deposited into the trust account or IOLTA account, or when the client signs the settlement document in the attorney office? So I guess when is there constructive receipt of funds, I believe is the way to put that.
Okay, got it. So I think the answer is it kind of, unfortunately, like most tax things, it sort of depends.
It depends, yeah.
When you sign the settlement agreement's done. I mean, I've seen circumstances and done it where we amend the settlement agreement for hopefully some other reason to say we're changing this, but we also want to be paid next year or something.
Right.
I mean, that probably works. But as to, I mean, the lawyer is always the agent for the client. So the question is sort of mostly, I think it's when the money hits. If you sign a settlement agreement but you don't get paid, it says they're going to pay within 30 days. You sign it in October, they got to pay within 30 days. But the defendant or the insurance company doesn't do it and pays you in February of the following year. When is that income? No question about it. That's February income.
Okay, great.
So I think you're okay there. And as to what happens if you sign it in October, the money comes as it's supposed to 30 days later in November, and then you hold on to the check and you don't deposit it until January.
Right.
Maybe you could defend that, but I'm afraid that's going to be, November, December income.
Right. It's going to be a little tougher to stand behind that. And we do have another question. Do you have to issue a 1099 for doctors that you pay for on behalf of the client as a case expense?
Lots of I read a lot or have written a lot of 1099 type opinions. The answer, I think in general, is probably, but there are exceptions.
Right.
I know I've supported and written opinions in some cases saying that you don't have to do it, but I think it depends. I think it depends on the nature of the arrangement, and I know it can be a sensitive issue. At least I remember that one can be.
Okay. And again, thank you all for joining us today. We really appreciate your time. And Rob, thank you again for your time.
Thanks, Paul. Bye, everybody. Thank you.
Y'all have a great day. Bye-bye.